Welcome everyone to our second installment of our webinar series. This month it's capital allocation decisions in volatile markets. We hope that this is a timely topic given what people are experiencing in the markets. We've got a robust team today to talk not only on the investment side from our advisor standpoint, but also from some of your peers in the co-op community who invest in and are participants in the markets. The meeting format, it's the same as always. We'll give a capital markets overview and then we'll spend about 25 minutes with our two special guests discussing some of the challenges that co-ops face. Then we'll have a Q&A after both segments. All attendees are on mute and we do have a question feature. Brian Allen will be manning the question box and we'll hope to get to your questions. If we run out of time or if we have to move on, we'll certainly respond via email. I want everybody to know, as always, this is being recorded and you'll get the recording via email next week. If you're looking for CEU credits, proof of attendance will be provided in that post email that you'll be getting. The market review and outlook. I hope everybody is buckled in, because here we are towards the end of March and it's been quite a market the first quarter of the year. With me today to go over the markets, given the volatility and what we've experienced, I brought along Mauricio, who is our head of fixed income, and Jim, who's our head of equities. You may know Mauricio and Jim if you look at any of our quarterly performance updates. So Mauricio Agadello and Jim Polk will be joining us. Let's get this started. A bumpy ride for stocks. I can't do justice for what we've experienced, so I'm going to ask Jim, who is our head of equity investments, to kick us off.
Good afternoon, everybody. Thanks for joining us. As the headline says, it's been a bumpy ride. It's been a bumpy ride for a while, particularly after just the terrific year last year in the markets. And although things have rallied in March, it has been, as the chart shows, really bumpy. And I would say the market's putting things into really three big buckets, right? So the first is interest rates, which Mauricio will talk about more. But when you think about a year ago and how benign the interest rate environment was, at least for the equity markets, and that's really gone 180 degrees. So the market's worried that the Fed is behind the curve. And there's lots of speculation about whether it's 25 or 50 basis points, but that's the first big bucket. The second bucket I'd put as COVID writ large, concerns about supply chains, the impact to demand, labor supply, inflation. We could talk the whole time just about that. We've been meeting with companies. Prabha Carpenter, my co-manager, and I were just recently at a conference. And you're hearing lots of different things about supply chains, about labor shortages. But I would say on the margin, things that seem to be getting a little bit better. But as one CEO said, it's like whack-a-mole with the supply chain. You fix one thing and then there's another problem. So that's the second thing that we're wrestling with in the equity markets. And the third thing I would say is obviously just the geopolitical situation, both Ukraine and Russia, which is obviously a very big deal and could have implications for inflation, for worldwide demand, for energy policy, but also the implications that could be longer term with China and Taiwan, for example. Lots of stuff going on there, but again, three really big buckets: the interest rates, big picture COVID, and then the geopolitical tensions that are going on. Mark, I'll turn it back to you.
As bumpy the ride has been for stocks, I've been at this for 39 years, going on 40 years, and the bond market, the fixed income market, has been as volatile as I've ever seen it. Here to hopefully put it into context, Mauricio, our head of fixed income, please take it away.
Thank you, Mark, and good afternoon, everyone. Thank you for the opportunity to be here today. As Jim mentioned, it has certainly been a bumpy ride for equities. The same factors that Jim just mentioned affected the fixed income market. To your point, Mark, this has been perhaps the worst start to the fixed income market ever. When we look across the curve and we begin with Treasury bills, negative return, we go to the 1 to 3 year Treasury part of the curve and we were down 2 and change %. Then we go a longer duration profile, something like the Gov Credit Index, and you're down close to 7%. And the ag down over 6%. And these are quarterly numbers. It certainly has been difficult. The main drivers of fixed income return right now is the repricing of Fed expectations for the future path of monetary policy. If we recall back to COVID, the Fed needed to act in a determined manner to prevent a further and more significant slowdown of the economy. This meant driving interest rates to all-time lows. The Fed went back to a zero interest rate policy. It meant reintroducing a quantitative easing and expanding the balance sheet further, providing support for corporations so that they could borrow into the market. Now that the story has played out, the Fed signaled in December that the factors affecting inflation were not transitory in nature any longer. Therefore, taking on a more hawkish tone heading into 2022. This has certainly spooked the fixed income market, and we know the inverse relationship between yields and prices, right? Yields higher, prices lower. A good sense of the war, it is healthy to see higher yields for the right reasons. It is healthy to see income being put back into fixed income. Let me hand it back to you, Mark.
As Jim and as Mauricio touched on, we're talking about volatility. And what are those drivers of volatility? Inflation is at a 40-year high. We said it in January, we're saying it again. Expectations for Fed tightening. How many, how frequent? It's anywhere from 7 to 9 times by the end of the year. Russia invasion of Ukraine. What we talked about in January, geopolitical issues. Well, we now have actual issues that are being displayed before our very eyes on TV. And we have valuations still at lofty levels. This volatility that exists in the market is going to affect the outlook for the remainder of the year when it comes to rates and when it comes to bond prices and when it comes to equity prices. If we look at the next slide, we expect rates to increase. And what's the latest outlook? I'm going to ask Mauricio, but this changes almost daily, if not hourly, depending upon what happens in the latest news cycle. Is there a peace accord in the Ukraine? Is the CPI number favorable or negative? So Mauricio, what is our outlook for the rates throughout the year? And I know this is somewhat of a moving target.
Thank you, Mark. We saw already in the last couple of weeks, the Fed actually increased Fed funds by 25 basis points, and it signaled that there is more to come in the near future. The next meeting will be in May. Right now, the market seems to be pricing in a 50 basis points increase at the May meeting. And we are also due to hear more details how the Fed is going to shrink the balance sheet, a process called quantitative tightening. If we see this forecast here, the top line forecasting the 10-year yield getting to about 2.5%, give or take 225 to 250 by year end. Well, guess what? We are there now. We're at 240 as of this meeting. The 2-year has also risen. The 2-year yield ended the year at 0.73%. And as of March 25th, it stood at 2.27%. So an increase of nearly 150 basis points in the front end part of the curve. And that has certainly contributed to the negative returns that we have seen in the fixed income market. Now, if we go to the next slide, here we can observe the cost of borrowing. What is this here? We're talking about the excess percentage points that average corporations need to pay to borrow capital in the fixed income market. We saw a big spike in 2020 during COVID. That came back down in 21 to all-time lows. And recently that number spiked with the invasion of Russia into Ukraine. More recently, that has improved. But as we see here, the terms are still very favorable for corporations. I will say that's one area where we are very constructive still, despite the volatility that we see in the market. Corporations were able to borrow at really attractive terms, terming out maturities and reducing interest expense. In fact, the cash and balance sheets has increased by almost 1.6 trillion based on research from Mitsubishi. If we go to the next slide, this is top of mind right now. This is what we see in the headlines. This is what we see in the news, the yield curve, and we're looking at two stands here. And the signaling from the yield curve at this point is one of warning caution ahead. It doesn't necessarily imply that a recession is bound to happen. When we look at data in the past during recessionary times, we have had yield curve inversions, right? Right now, 2 stands is nearly a zero. This is in anticipation of the rate hikes that are coming this year, which as of this morning, the Fed fund futures were pricing in a total of almost 925 basis points hikes. We don't have 9 meetings left this year, so that means a couple of 50 basis points increases in there. And the 10-year is a reflection of growth. We are seeing a slowdown. We don't think it's going to be very profound, but it is certainly something to be mindful and to be watching here in the market. Next slide, please. When it comes to fixed income, as I mentioned, the inverse relationship between yields up and prices lower, that goes for duration in a portfolio. So when you are in the front end part of the curve, 5 years and in, you have lower duration. So that's less sensitivity to interest rate moves. So for, let's say, a duration of 3 for a portfolio, if you assume a parallel shift of 100 basis points, that implies a negative 3% return for the portfolio. The more you extend out the curve, so if you have a duration of 6, you're now looking at minus 6%. And that's what we have seen basically in returns in the fixed income spectrum this year. Additionally, during periods of volatility and overall economic weakness, the higher quality that you are, the less sensitive borrowers will be to experiencing a wider credit spreads, which could also put downward pressure on prices. So at this stage, lower duration and higher quality performing better.
Before I hand it over to Jim to comment the cost of borrowing, everybody talks about what's in the Federal Reserve's toolkit to slow down inflation, obviously rising interest rates. But what does that do? Mauricio talked about the cost of capital for corporations. There's also a cost of capital for individuals. When we came out of the pandemic, we had a lot of people sitting on cash. The service economy basically came to a halt. There was an increase in consumers buying appliances and whatnot, but the car market dried up. And all of a sudden that exploded because people had disposable income in their pockets. And we saw that take off with the economy. But as the Fed raises rates, as we've already started to see, that cost of capital, whether it's a home mortgage, car loans, this will slow down that consumer propensity because cash is cheap to borrow. The more expensive it gets, the harder it is for those people to meet those payments. That's what slows down the economy. It's finding what that right number is. So whether it's 7 rate hikes, 9 rate hikes, 6 rate hikes, when we start to see the effect on the consumer, you'll see the Fed react accordingly. But it also affects the stock market. And here I want Jim to touch base on the impact of rising rates that has on sectors that help drive equity markets. Jim?
Thanks, Mark. And I'll just reiterate something that you just said, which is what's that right rate? What's the right rate that they talk about a soft landing that gets the consumer to slow but not stop? And again, I referenced the conference that Prab and I went to where we got a chance to meet with a bunch of companies. And right now they are continuing to see really strong consumer demand. So we'll see how that goes. The next 2 slides tell maybe the same story slightly differently. The first basically just suggests that when the Fed begins the tightening cycle, it's not time to panic and it's not time to run out of the market. The market can actually do well from the beginning of the tightening cycle to the end of the cycle. These are the last four cycles from 94, 99, 04, and 15. And these are the averages of how different sectors have done and obviously different things that were going on at the time. If you look at that middle bar, just the S&P 500 itself was still up almost 8%. That's kind of long-term numbers, right? That's a historical average. And so it sort of suggests that we have a long way to go, and we're trying to determine what the Fed is going to do, how much they're going to raise, if they're going to raise too much, et cetera. For us on the equity side, it's not the way we run the portfolios. We want to have a broad, diversified portfolio in these sectors. We think that's the way to win in the long run. If you turn to the next slide, you can actually see that in the long run, you want to be in the market. And if you have a long duration mindset, that these can be opportunities to be adding. And if you're in short duration, then you shouldn't be in the market. You should have that allocation into fixed income or into something else. I will tell you, I've looked at this chart and I've looked at it a gazillion times myself on Bloomberg. And I'm always struck by how bad I feel and one feels in times of corrections or bad markets, but how right it was to stay in the market over the long haul. And so with that, Mark, I'll turn it back to you.
Thank you, Jim. Thank you, Mauricio. This is what we said in January. Fast forward, we're a couple of days away from the second quarter, and it's the same bullet points. And actually, what we said in 21 was pretty much the exact same thing. Higher costs for goods and services, inflation is here to stay. It's not transitory. As Mauricio pointed out, we even hear Chairman Powell saying that now. Maybe he took a page out of our market outlook back in 21. Higher wages keep up with inflation and labor shortages. What we said in January holds true today. We had a decade plus of relatively flat wage increases, and we're starting to see that turn around. Many of you out there know what it's like in the hiring process. It's more competitive now. Rising interest rates, 5 to 7 times in 22. As Mauricio pointed out, that's 7 to 9. I will tell you, in March of 2020, we were talking at the end of 23 into 24, the Fed starting to do something. Here we are already in the first quarter of 22 that we've had our first tightening. It's a very volatile, it's a very fluid market, and we can't predict how many times and how often. But we will tell you that we feel still strong, especially on U.S. equities, that the markets continue to perform positively, but at a modest pace. So we're not going to see the 20% returns like we did in 21. And even in 2020, when we were down 34% in March, we ended the year relatively flat to positive. We eked it out. Volatile markets will continue in 22 as we deal with the pandemic, inflation. We haven't even talked about midterm elections yet. That's whole nother conversation that's forthcoming. And then really the global hot spots, not spots, but hot spot. What does this all mean? Jim touched on that slide about the long term. Brian, has anybody put a question in front of the group before we move on?
Thanks, Mark. Right now, we have no questions from attendees. So I think in the interest of time, let's just move on to the discussion with our speakers today.
Thank you, Brian. I know we covered a lot. It was really great to hear from Jim and Mauricio, but it isn't all doom and gloom. It isn't the sky is falling. It's having a disciplined approach to investing. If we can go to the next slide, what are capital allocations decisions that you need to make in volatile markets? How do you navigate these choppy waters? We're very fortunate today to have with us two very special guests. Stan Furberg is the CEO of Novec, one of our largest distribution cooperatives, also one of our largest investors in the Homestead Funds, and one of our longest, along with Ed Rougemont from New Mexico Rural Electric Cooperative Association, the statewide, who again, a long-term investor, quarterly conversations, annual meetings about their needs, about their liquidity needs. I wanted to bring Stan and Ed to talk about their individual co-op journeys through volatile markets. But first, I'd like to ask Stan and then Ed to introduce themselves, because I could never do justice to what they do within their co-op and a little bit about their co-op. Stan, why don't you kick us off?
Thank you, Mark. Appreciate the introduction and very pleased to have been invited to speak with the group today. I've enjoyed the privilege and honor of serving as the President and Chief Executive Officer of NOVEC, which is an acronym for the Northern Virginia Electric Cooperative. I've been doing that for a little over 30 years. And NOVEC, by virtue of where we are geographically, we are not your typical rural electric cooperative. We serve just about 178,000 customers in 6 counties in the western suburbs of Washington, D.C. Our headquarters is about 15 miles away from Mark's office. When I say we're not typical, it's not just the size. We have about $1.2 billion in assets, about $700 million a year in annual revenues. But the customer base is probably most unusual. It's a highly affluent, highly educated customer base. We serve the tech industry here. Northern Virginia is reputed to be the location where 70% of the world's internet traffic flows, not the United States internet traffic. 70% of the world's internet traffic flows through Northern Virginia. We have more than 30 computer data centers on our system with loads of hundreds of megawatts. The total system load is about 1,400 megawatts. We serve a number of government agencies, including several spook agencies and Mount Weather, located up in Loudoun County, which is where the big shots of Washington will go in the event of a nuclear attack. Again, our customer base is most unusual. We also have a natural gas subsidiary, a fiber optic subsidiary that holds 4 patents on a technology that allows the data to flow simultaneously in both directions over a single fiber. We also, of course, provide home warranties and other energy kind of related services. But if I can impress anything on the group today, it's here in Northern Virginia, we're just not your typical rural electric cooperative.
Thank you, Stan. Ed, if I could ask you to give a little bit background for our audience.
Thank you, Mark. My name is Ed Rougemont, and I have worked for the New Mexico Rural Electric Cooperative Association for the past 9 years. My primary responsibility is to manage our workers' compensation fund. Since we self-insure our member cooperative employees across the state of New Mexico for injuries that they sustain at work, you can actually say that I'm their insurance agent when it comes to workers' compensation. So the premiums that we receive from our member cooperatives, that money is sent over to Homestead and RE advisors, and they invest and manage our portfolio. Having said that, I work very closely with the investment advisors for those organizations and on our fund portfolio, and I enjoy working with them on a quarterly and annual basis. Thank you.
Thank you. We talked a lot about what happens through various market cycles. And on this slide, we go back to 87 because there's been some significant events since 87, but we also had a slide that went back to 1926, close to 100 years. So as much as times change, a lot of things remain the same. So Stan, I'm going to throw this one at you first. As a long-term investor and in the chair at NOVEC for as many years as you have, what does a long-term investor look at, and what is some of the process that you look at when you go through, even if we just go back to 87, how has your co-op reacted in the accounts that you have through these various market changes?
Great question. I'm old enough to remember the crash of 87, having lived through it. And I was not with NOVEC at the time. I came here in 1992. I was at that time with an investor-owned system in New England. But again, I've seen enough of these bubbles that have come into existence and then have burst very suddenly, whether it was the 87 crash or the 2000 tech bubble, the real estate bubble of 2007, 2008, and the succeeding recession as a result of that. And our chief financial officer, Wilbur Rollins, and I think are of a like mind. We're both very conservative in our approach. However, Wilbur and I both have a strong belief in the viability and success of American business and industry. If a person has that belief, then I think the logical extension of that is you stay invested in the market. Nobody is smart enough to time the market. And as the charts show, both this chart and the ones before, that staying invested in the market has proven over time to be a wise decision. The funds that we have with Homestead, which we've had for a number of years, as Mark said, we have tried to keep a sizable portion of that in equities. We rebalance from time to time. However, again, based on a strong belief in the future success of American business, we really like the equity side.
Thank you, Stan. I was down visiting Stan about a month ago, and we talked about the U.S. markets. And based upon that conversation, and Stan brought it up twice in the conversations on this particular slide, we're actually working on a piece about investing in the U.S. during times of uncertainty. So a little commercial interruption that we will be having a one-pager out on U.S. businesses. What's been New Mexico's approach around market changes? You mentioned conversations. Anything you would like to add on this slide?
The only thing I would say to that, Mark, is have a plan in place. That's probably the most important thing that companies and individuals learn over time, is the market has shown that it has rebounded.
Great intro into the next slide. And hold that thought, Ed, because when we think about the balance of risk and return and stay the course, everybody's course is different. We've worked with New Mexico for the past, I don't know how many years, and we've done a couple of different asset allocation reviews with you. Specifically when it comes to balancing risk and return, how has the various asset classes and the process helped New Mexico balance risk and return?
Thank you, Mark. I'll start off by saying what our asset allocation plan and our investment strategy is currently right now. And then I'm going to step back and go over to what it was historically. But in order to meet liquidity needs, we have a 25% amount in money market accounts, of 40% exist in fixed income securities, and 35% are in equities. So our view is also to monitor the portfolio, and if there's any rebalancing that needs to take place at any time, because there could be different triggers that could affect that. I have worked with your team in doing so. If I can, I want to go a little bit and discuss the history of the fund. 10 years ago, our fund strategy was 25% in cash, money market, and 75% was in fixed income securities. You can't effect change immediately, so our board decided to start making changes to that asset allocation plan and our investment strategy, and to start diversifying our portfolio even more so. And starting in 2013, we started stepping back from fixed income, since 75% of our portfolio existed in that. And in 13, we increased equities to 10%. In 14, we increased that to 20%. And in 2015, we increased that to 35%. Now, in each of these categories, we have a plus or minus 10% fluctuation that allows us flexibility so that we're able to meet our operational costs and continued investment strategies. Additionally, in 2017, the board decided to even diversify even further. And we decided to diversify our equities portion of our investments even further. And so at that point, we started getting into more of the mid and small cap, very small percentages, like 10%. But we got into more of those instead of just having all our equities in one Homestead fund, mutual fund. It's worked out for us. I would have to say that since changes were made to our investment strategy, over time, over the last 8 years, we have been able to pay premiums or dividends, call them what you may, in the tune of $3.9 million over the last 8 years. And that's primarily due to two things: productive investment experience and a great safety program resulting in low claims experience at a cooperative level. As a side note, we had not paid dividends since 2002. We are now on an 8-year run in paying dividends to our cooperative membership.
That's quite impressive. When you put together a plan, it's always important, at least on an annual basis, to look at that plan and see if your risk return profile has changed, and do you need to tweak the plan? And going back in your experiences, you've tweaked the plan every couple of years as your expectations have changed a bit, but philosophically staying the course along the way. Stan, when you think about Novec's balance of risk and return, you all were long-term investors in a couple of funds, but in recent times, you've done a little balancing of risk and return on your own. You care to share with the audience your experience?
Well, as you say, Mark, we rebalanced, I guess it's been about a year ago now, and we took some of what we had in equities and moved it into fixed income. I guess perhaps unlike maybe some other folks who may be involved in the webinar as attendees, Novec has plenty of cash for its cash flow needs. So our relationship with Homestead has always been long-term kind of investment. We have no desire nor intent to have to cash out any of our Homestead investments just to meet cash flow. We're able to meet all of our cash flow needs, which are substantial since we are responsible for our own power supply. Our power bill in the course of a year is about $450 million, but we're able to meet those cash requirements basically from operations. So we look at Homestead as a vehicle by which to make longer term investments, but we did rebalance about a year ago.
You touched on an important part of short-term, intermediate term, long-term. It's a good conversation. Every co-op is different. Every investor, whether you're an institution like an electric cooperative or if you're an individual, everybody has different risk, liquidity, and return expectations. Stan, you touched on cash flow needs and what your co-op uses its long-term portfolio in, perhaps a little bit heavier equities, but a little transition to fixed income, taking a few chips off the table, if you will. But when an electric cooperative looks at 9 months and in, that's working capital. When we talk about this slide, it's the risk return profile for all of your investment needs. And when you get past 9 months, a conversation should be had about how much do you invest versus how much do you keep, for lack of better terms, in the checking account at the bank. Stan, anything to add from what you just shared about when you think about balancing risk, liquidity, and return?
I think the chart really says it pretty well. When you look towards the right-hand side, where you call the strategic investments, most of our investments in Homestead are related to our FAS 106 trust account. And that's long-term. That is intended to serve the needs of retirees and as part of their Medicare supplement post-retirement. And so that is truly a very long-term outlook. It's not even 1 to 3 years, and it's clearly not 0 to 9 months. Our funds invested with Homestead are a very long-term horizon. So I think the chart says it very well. For folks who need working capital, if you don't have cash on hand, then you're looking at essentially lines of credit. And I guess I'll throw in another piece of advertising about Novec. We're one of the few electric cooperatives in the country with a AA- credit rating from Fitch. Fitch requires a tremendous amount of liquidity to get a AA credit rating. And so we do that with a combination of our investments, our cash, our operating capital, and a few lines of credit.
This is where our asset allocation questionnaire comes into play here, because these are the types of questions we ask in our questionnaire about the duration of the investment, what type of account. You spoke about a FAS 106. Ed, you mentioned a workers' compensation plan.
That's correct.
In this bucket, where would you say, because you do have annual needs perhaps in that, when you say on the risk return profile, where would you say from a reserve to strategic, where do you fall, or where do you plot on that chart with this particular pool of assets?
Well, in respect to our working capital, we have 25% that sits in cash, plus or minus, depending on our needs. So we can go all the way up to 35% in cash. I'll give you an example. In December of of 2020, we paid out close to 800,000 in dividends back to our membership. And then we have some large ticket expenses beginning of the year for reinsurance. So those big ticket expenses plus paying dividends, we have to increase our working capital towards the end of the year, beginning of the new year. Those two trigger points allowed us to have to rebalance our portfolio again to get it back into perspective. And so the other thing I would mention, the premiums that are paid on a quarterly basis, that's another tool that is provided to the fund and to Homestead and the RE advisors to say, okay, where is money needed to ensure that portfolio remains in balance? And having that tool and having that revenue that comes in gives us flexibility in doing so, because we need to be able to meet our working capital expenses from a claims, paying for claims on a long-term basis, and then paying for those one-ticket expenses that we have at the end of the year and beginning of the year.
Thank you. It's definitely a relationship that, given your liquidity and the structure of your particular account, it's a communication process throughout the year to meet expectations. Whereas a strategic account, when you go through volatile markets, patience pays, as Jim pointed out in that one slide, because there are bumps and highs and lows throughout the course of a longer term investment. But we can't predict when the market is going to go up, and we can't predict when the market's going to go down and when you should redeploy cash. To close, it's very important to have a conversation about what your particular investment needs are, what type of structures, what type of assets, what's the liquidity, what's the credit quality, what's the duration, whether it's in equities or fixed income or combination or even hard assets. It pays to have a plan, and it pays to review that plan, because markets are volatile. And the pace of volatility, as we have seen in the past 2 years, we've had multiple types of markets in the past 2 years. Speak with us if you'd like, and we can go over that profile and go over your expectations. I want to thank Ed and Stan and Jim and Mauricio, and I'm going to open it up to questions and ask for you four to just stay on in case I need to throw it at one of you four. Brian, do we have any questions in the queue?
Yes, we do. This question is actually for Stan and Ed. The question is, does your co-op have a view on portfolio rebalancing? And is it something you undertake at specific times of the year, or is it something that is driven by market volatility and fluctuations in account values, kind of what we're seeing right now?
Ed, if it's okay, I'll go first. We had not rebalanced for a while, up until about a year ago. And so I don't know that for our needs at Novec that we necessarily would do it on an annual basis. We have found that the folks who work at Homestead know what they're talking about. So when they recommend that maybe it's time to take a look at the balance of investments and we might be due for a rebalance, we say, okay, let's take a look at it. I don't know that we need to do it on a calendar basis. I think you just have to look at external forces, the direction in which the political winds may be blowing, and then internal needs.
Thank you. Ed, any thoughts?
Yes, we had a need to rebalance in 2021. We look at it every year. We look at our percentages on a quarterly basis, but we do keep an eye on the need for rebalancing. Since I've been here, we've rebalanced once, and that was due to some very large ticket items that we had. But Homestead and RE advisors, they keep a good eye and control as to our portfolio and what it looks like and where the percentages are. And even if they're getting close, I'll get a call from Brian or Mark and we'll discuss it. But for the most part, we've only had to do that one time, but we look at it all the time.
Again, two different types of investment accounts, New Mexico and Novec, with different expectations and for different pools of capital, if you will. We're coming up on the end of the hour here. Brian, anything before I wrap this up?
Oh, no other questions at this time.
I want to thank Mauricio and Jim for joining me, but I also want to thank Ed, and I want to say a special thanks to Stan, who is retiring. Stan, I hope you don't mind me telling the audience that Friday, your last day at Novec. You have been a tremendous supporter of the Homestead team. I think your market acumen has serviced Novec extremely well over the years, and certainly your leadership at the co-op has been instrumental in the growth and all of the things that you shared with us. So we want to wish you nothing but the best, and most importantly, thanks and appreciation for all that you've done to support our group over the years.
Thank you for those very kind words, Mark, and it's perfectly appropriate that I am retiring on April Fool's Day.
Well, thank you very much, Stan. I look forward to catching up with you once you get your feet on the ground. But Ed, Stan, thank you, and all our participants have a wonderful day. And please, if you have any questions, don't hesitate to contact us. That's what we're here for. That's my information on the screen. Please feel free to reach out to me directly. And thank you very much, and have a wonderful afternoon.